The number one thing to grow your wealth through property investing: income. That's it. That's the number one thing to fast track your wealth through property investing. We could literally make a 10-second video and just end it right here, to be honest. But let me elaborate on this. Now, in the property industry, you're going to see a whole lot of property gurus, spruikers. They're going to try to tell you all these different tactics and secret strategies on how you can fast track your property investing journey, continue building your wealth, and grow a 10+ property portfolio on an average income, which, by the way, you don't need 10 properties to build a substantial amount of wealth, because the number of properties doesn't matter. It's about the quality of the assets and what they actually do for you. But look, anyways, you're going to see all different sorts of strategies. For example, in the past year or two, you've seen a lot of agents and experts tell you to buy in a trust. But it doesn't work like that, because let's say you actually did utilize that trust strategy. You still need to have a very high income, because in the current interest rate environment, even with a 20% deposit, and in some cases, if you're buying in large regional cities or metro areas with strong growth potential, you're going to need more than a 20% deposit in most cases to make that property neutral cash flow. But look, let's say you need a 25% deposit for a strong capital growth focused residential asset that you can make neutral cash flow in that trust. Now, look, for those who don't know, that this trust strategy that I'm talking about, and you keep hearing people talk about, it's this so-called endless borrowing capacity strategy, basically where you hold the properties in a trust, and as long as that trust is neutral or positive cash flow, certain lenders will ignore that trust because it's self-sufficient, it's just looking after itself. So they ignore that when they reassess your borrowing capacity, and basically you just have the same borrowing capacity as if you didn't own all that debt in that trust, because it's just automatically just looking after itself, right? So in theory, you can just repeat that process. You can just buy properties in a trust, make them neutral or positive cash flow, set up another trust, buy properties in that trust, make them neutral or positive cash flow. Just, you know, you can just keep repeating that process. But here's the problem. You bought that property, you've made it neutral cash flow, but you spent a lot of cash to make that property neutral. Like I mentioned, in this current interest rate environment, you're probably going to need 25% deposit or more. Now, let's say you want to use equity to buy another property, but as soon as you take out that equity loan, that property is going to be negative cash flow once again, because you've increased your loan amount, which means that you're going to need savings, and you'll need to save up a large deposit again for your next investment property if you're trying to utilize this endless borrowing capacity trust strategy. So unless you've come into a whole lot of cash, maybe your parents have helped you out, maybe you've inherited some money, or you're on a very high income where you can save big, the trust structure just isn't suitable for you. Even large lenders like Macquarie recently have just put a pause on trust and company lending. And one of the main reasons is because what's been happening on social media. They've literally mentioned this, that all these property experts on social media just keep pushing this endless borrowing capacity strategy using trusts, and people are going and buying properties in trusts when it's not even suitable for their situation. And trust lending is a little bit more complex for lenders and for people who are actually looking to buy in trust as well. It's not as straightforward and simple as buying in your personal name. In fact, buying in a trust when it's not suitable for you can actually impact you negatively, because let's say you can't save up money for other properties or set up another trust, and if you don't have a very high income and you don't have a lot of cash, now you can't even claim that negative gearing because you've bought it in a trust, so it just hurts your borrowing capacity even more. In a trust, you can only claim losses when you sell the property later. So all these unclaimable losses in the meantime, you can't negatively gear that against your income, which affects your cash flow, which affects your borrowing capacity. So people out there who are telling you that you can work at McDonald's or Coles, maybe you can earn $70,000 a year and buy 10 properties. No. In the current interest rate environment, you're looking at around 5 to 7 times your income, right? So if you're earning, let's say, $80,000 a year, and assuming you don't have any dependents, you're generally looking to borrow somewhere between $400,000 and $560,000 of the bank's money. That's it. You're not buying 10 properties with that, right? I see all these stories about someone who was on an average income and they've built a property portfolio of 5 properties in just a couple of months, but they leave out half the story, which is they don't mention that that person may have come into a lot of cash to start off with, maybe gifted by a family, or that they owned a principal place of residence for like a whole decade. They built up $500,000 to $1 million of equity. Then they sold that principal place of residence, which you don't have to pay tax on, by the way, if you sell your principal place of residence. because it's your principal place of residence, not an investment property, and you have that $1 million in cash or even more to just buy multiple properties in a very short time span. That's the reality. All right, so unless you have a very large income, you're not scaling a portfolio quickly. Mortgage brokers can only do so much. The biggest thing that influences your borrowing capacity is your income. And I'm sorry if I keep saying this and people don't like hearing this, but I'm tired of all the outlier stories and the BS strategies that are being pushed by property gurus. There's a lot of noise in the property space, but I'm telling you now, income is the number one thing that you can change to directly influence your borrowing capacity and your ability to continue growing your portfolio and your net wealth as quick as possible. The more money you make, the more money you have to invest. It's really that simple. Now, if you do have a modest income, let's say an average full-time salary or even a bit less, you can still build a serious amount of wealth. It's just going to take you more time. The higher the income, the less time it's going to take you to build more wealth. Because if you're on a modest income, your borrowing capacity is going to be limited. You're not going to be able to save as quickly for your next property, and you won't be able to maybe spend as much on renovations in the future or development opportunities to kind of fast track your equity growth. It's not impossible, it's just slower. Don't fall for people saying, look, you're on $50,000 a year, don't worry, we'll get you 5 properties in 2 years, or you've got $60,000 in savings, we'll get you there, just buy, just buy a property, pull out equity, buy another one. It just doesn't work like that. And if you don't have income, you don't have capacity. If you don't have capacity, you can't scale. That's simply just how it works. Now, what I'm seeing right now in the property market is the game is changing. You're going to need higher and higher incomes just to get into really good high growth assets that actually change your life. Because property prices in the right areas, they're only going one way, which is up. Those days where you could buy in Townsville or Rockhampton and get 50% growth in 2 years with 7%, 8% yields, those days are gone. You're not getting those type of yields in high growth areas anymore for the same prices as you could buy back in those days for $300,000 in Townsville or Perth or Adelaide, for example. Things are changing very fast. So if you really want to build wealth through property, you need to focus on increasing your income. That is the number one thing that you can do. Work overtime, get a second job, learn new skills, do whatever you need to do. People might get annoyed hearing that, but if this annoys you, then maybe this isn't for you. You're not going to build millions in property sitting around thinking you're entitled to easy wealth in Australia. I'm telling you, those days are gone. When I bought my first property at 21, I did have an advantage because I was living with my parents. I wasn't paying rent and a lot of living expenses. But I did move out not long after, to be honest. But look, at that time I bought my first property. I was studying a full-time bachelor's degree. I was working full-time hours at a warehouse on casual rates as well, good hourly rate at that time. And just so I could save up for my first property. I was studying full-time and I was working full-time. After I finished my degree, I started working as a psychiatric nurse, still on casual rates because I wanted to earn more and save faster. And I was working 7 days a week. I'm not exaggerating here. Even in my first few years of nursing, I was earning more than the senior nurses and the big bosses and managers above me simply because I was putting in more hours. I was working 56 to 70 hours every single week. People used to tell me, oh, you're young, you should just enjoy your life. I heard that so many times. And I'd always tell them, look, I'll enjoy it later because I knew what I was doing and why I was doing it. I had big goals and I wanted to do anything that I possibly could to make sure I reached those goals as fast as possible. Now I've got a family to feed. I've got a 15-month-old daughter. But I'm in a way more comfortable position financially now than what I used to be when I was younger. But I'm still working 62 to 70 hours every single week because my goals are even bigger now, and same thing as before, I will do whatever it takes to reach those goals as fast as I possibly can. And you need to have that same mentality if you want to build serious wealth through property investing today. You need to do whatever you can to increase your income and get into your first property. And here's the thing, a lot of people think, look, I've worked hard, I've increased my income, I've bought my first property, now I can relax. And that's one of the biggest mistakes because after you've got your first property, that's when you need to find ways to work even harder and make even more money. Because now that you've got an asset working for you in the background, if you take your foot off the gas, the momentum dies. If you slow down, your savings slow down, your borrowing capacity weakens, and you're not able to build wealth as quickly. Even if you've built up the equity in that first property, you might not be able to use it if you've decreased your income and taken your foot off the gas, right? So that's why I say, even after your first or second property, that's the time to double down and continue finding ways to increase your income. So until you've built enough wealth through property where you can maybe sell off a few properties and maybe buy a $2 million commercial property in cash or a block of units that pays you that 100K plus passive income a year, you shouldn't slow down, because property prices aren't going down. Affordability is only going to get worse. And the only way to win this game is to increase your income and continue outworking as many people as possible. So don't listen to these property spruikers saying, look, just buy a house and land package, claim the negative gearing, you'll be fine. Don't listen to the people saying, oh, you're on $70,000 a year, don't worry, you can just buy in a trust, or you can just buy 10 properties very quickly. You just have to know the right strategy. That's just not how it works anymore. And if you want to build real wealth through property, you need to find ways to increase income by any means necessary, legally, of course, but do whatever it takes, because to achieve uncommon results, you need to take uncommon actions. If you found value in this rant, then like, share, subscribe. You know what to do. If you want to learn how to maximize your growth through property investing, the link is below. If you want it done for you, the link is below as well. I'm Alan, and I'm here to help you maximize your capital growth through property investing. Let's go.